Welcome everyone to Vested Interest. This is Shane back again for another Stock Pick of the Day video. It is Tuesday, October 29th. We are going to take a look at one out of the industrial sector, Stanley Black & Decker. If you could do me a big favor and hit that thumbs up button down below if you find any value in the content. If you are a dividend growth investor, make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Click that notification bell so you're notified whenever we put out any new content. I do this Stock Pick of the Day video series Monday through Thursday whenever the market's open. We take a look at a stock that's pulled back on the day to see if it is presenting any value. We're going to run through some metrics. We'll see those here in a second. Drop a comment down below. Let me know what you think of Stanley Black & Decker. Is it in your portfolio? Is it on your watch list? Is it one maybe you're selling out of? And thank you, a special thank you to all the subscribers out there. You guys are awesome. The channel continues to grow because of people like you. A couple of other things before we keep going here. One, watch time is one of the metrics that the YouTube algorithm uses to spread the video. So if you could watch the videos to the end, that would be great. And two, there is a new feature on the channel. Now that we have been able to monetize the channel, monetization is based on having a certain amount of subscribers and a certain amount of watch time. So we have met a couple metrics that we're able to monetize the channel. So that means maybe if you see some ads on the channel, if you could watch those, that helps out. I would get ad revenue. And then the other way they do it, there is a thanks button, the three little dots down there near the subscribe and near the notification bell. If you click that, there's some other icons. One of them is the thanks button. That's a way if you wanted to donate to the channel, you could. I think there's $2, $5, $10, might even be a $20 tier there. And again, it's just a way to help out the channel. If you're interested, no pressure, not asking for that. If you can't do it, no problem. Again, those of you that can, I would appreciate it. And thank you so much to everyone who's taken the time to do all of those things. Let's continue to go. Now, this is the Vested Interest Stock Screener. This is how I look at a company on a high level to see if I'm interested in adding it to my watch list. Thousands of stocks out there in the market. It just gives me a quick criteria to run through before I do more of a deep dive. And then if it makes it onto my watch list, I do more of a deep dive into the financials of the company, looking at the balance sheet, the income statement. I'm looking at stuff like debt to equity ratios. I'm looking at their assets over liabilities. Do they have more assets than liabilities? So if they had to sell off parts of the company to pay down debt, are they paying down debt? Are they diluting you as a shareholder? Is their revenue growing over time? Are their margins growing over time? There's PEG ratios I look at, price to book ratios. Typically, I compare a couple different companies in the same sector and look at their price to book ratios. So we're going to go through this criteria to see if Stanley Black & Decker makes it onto my watch list. It must meet 5 of 8 since it's in the industrial sector. If it was out of the financial sector, a bank or an insurance company, I add in price to book using 1 as fair value. And you can use price to book for any company, but if it is not in the financial sector, don't blindly use 1. Like I said, when I look at companies like this one out of the industrial sector, I'll compare Stanley Black & Decker to other companies in the same sector, so in the industrial sector, that maybe make the same type of products. With Stanley Black & Decker being a company that makes tools, I might compare it to like a Snap-on or a company like that. So that gives you an idea how to use price to book for companies outside the financial sector. You can also look at price to book for the same company over time. So let's say the price to book is a 2. And over the last 5 years, it's been around a 3 or a 4. Maybe it's a little undervalued based on price to book, right? There's other metrics out there to look at as well. And go ahead and feel free to make up your own stock screener. Use this one as a base if you want and change what you need to. And definitely make sure you are setting your own investing criteria and only investing in stocks that you understand. If you don't want to do that type of research, there's nothing wrong with that. You can still invest in the market. Warren Buffett recommends for the average investor the S&P 500. So an ETF or an index fund that tracks the S&P, something like VOO, the Vanguard S&P 500, SPY, SPY is another one. Several others out there that track the S&P 500, which is what Warren Buffett would recommend. Now, getting back to Stanley Black & Decker, check them out on their homepage, www.stanleyblackanddecker.com. That's www.stanleyblackanddecker.com. That is their homepage where I pulled this information from. Headquartered in the USA, Stanley Black & Decker provides tools and innovative solutions you can trust to get the job done, and we have since 1843. So they've been around well over 100 years, and just as they said, they are a tool supplier, right? And some of the brands underneath their umbrella, DeWalt, you probably are well aware of these. I have a lot of DeWalt products. Craftsman, same thing. I've got a lot of Craftsman products. Stanley, I believe I've got 1 or 2 Stanley tape measures. Black & Decker, not sure I have much of that. Cub Cadet, if you're mowing your yard. Lennox, I believe, is a I believe Lennox is actually in the AC. I don't know what Hustler is. Troy-Bilt is another one. I know I've got a lawnmower that has a Troy-Bilt motor. I believe even my snowblower has a Troy-Bilt motor. So these are some very well-known brands, and if you didn't know they were all under Stanley Black & Decker, now you do, right? It's not just Black & Decker, it's DeWalt, Craftsman, Stanley, the others, as we discussed. Now, the reason we are taking a look at them, down 8.78% on the day, we are talking about Stanley Black & Decker, ticker SWK, out of the industrial sector, closed out the day at $93.89, 52-week range as low as $77.70, as high as $110.88. So they are kind of floating in between their 52-week high and their 52-week low. They are not within 15% of a 52-week low. When I did the math, I think they need to be $89 and below. Let me look real quick. I had it on my phone. What was it to be? So I get the right number here. So that's 77.7 times 1.15. Yep, $89.35. So it needs to drop below $89.35 to be within 15% of a 52-week low. Market cap of $14.454 billion. A beta of 1.24, so they are slightly more volatile than the overall market. That's what beta is. It tells you the volatility of the market. 1 being the market, anything over 1 more volatile, anything under 1 less volatile. PE ratio is not listed, leaves me to believe it's in the negative. EPS is in the negative, negative $1.81. Not good so far, not starting out on a good foot here. There may be a reason that it's down 8.78% beyond just the earnings date was today, and I'm assuming something in their earnings date was not to the market's liking, whether they missed the top and bottom lines or whether their forecasts were lowered. Whatever the issue is, you should check out their earnings because a big drop on the day. For dividend, $3.28 on the year. They are a quarterly payer. Divide by 4, though we will see that here in a little bit. Nice starting dividend yield, 3.19%. Ex-dividend date coming up November 29th. Looks like they're going to pay out December 17th. And according to Yahoo Finance, they do have a $112.80 target over the next calendar year. And I'm not affiliated with Yahoo Finance, just one of the sources I go to for information. So they see it actually setting a new 52-week high, at least according to Yahoo Finance. Jumping over to the right here, we're going to take a look at dividend yield theory. To do that, we look at the 5-year dividend yield average at 2.63%. We compare it to their current 3.19%, or over here where it says forward annual dividend yield, 3.19%, same number. And since it is higher than their 5-year average, that speaks to undervaluation. Again, these numbers are inversely correlated. With it being higher speaks to undervaluation. If it was lower than their 5-year average, that would speak to overvaluation. So right now, according to dividend yield theory at least, this one is potentially undervalued. Payout ratio, way too high, 300%. That screams dividend cut is possible, right? We don't want a payout ratio over 100%. I like under 75%. So this one is way too high. Now we're going to drop down and take a look at free cash flow. I like growing free cash flow over time because typically if a company has growing free cash flow, they have growing dividends to match. So going back to 2021 here, you can see $144 million in free cash flow. 2022, you can see negative $1.9 billion in free cash flow. That's not good. Must have been a big write-off or something here. 2023 up to $852 million, and the trailing 12 months up to $1 billion. So it looks like since their bottom in 2022 here, maybe they've been growing. They also are repurchasing a little bit of shares, or at least they were. Doesn't look like they've done anything in the trailing 12 months. They did up through 2023, $784 million in 2021, 2022, big purchase here. Maybe that's part of this free cash flow drop, right? They took a lot of money here and bought back a huge chunk of shares, $3 billion in repurchased shares, and then 2023, $16 million again. So I don't like the free cash flow. It has been growing since 2022, but a big drop in 2021 here. Now, jumping over to stockanalysis.com, another source I go to for information. I always recommend more than one source so you can make sure the information you are getting is accurate and up to date. You can compare sources. Sometimes sources are late to update. Sometimes they're just wrong. It happens. They have 8 analysts that have taken a look at this. They call it a consensus hold. They have a low estimate of $88, which would represent a 6.27% decrease from where it currently sits. Average estimate of $102.88. That would represent a 9.58% increase from where it currently sits. And if it happened to hit their high of $118, which is pretty close to what we saw with Yahoo Finance in the 112 range, that would represent a 25.69% increase from where it sits. All the while, you could collect that 3+% dividend yield if they maintain the dividend. Like I said, 300% payout ratio. That one, in my opinion, is in danger of being cut. That is way too high. They need to do something to bring that down. And sometimes that is diluting you as a shareholder and selling at different shares. additional shares, but they have been repurchasing at least up to the past year, 2023, not so much here in 2024. But let's continue on. Looking at statistics, I like to look at return on equity and return on invested capital to see how well the company is reinvesting back into itself. And looking at ROE, return on equity, I like 10% or better, negative 2.03%, not good. Return on invested capital, I like 10% or better here, 3.71%, not even close. So neither of these beat the 10% I'm looking for. EPS growth forecasted over the next 5 years, I like 5% or better projected over the next 5 years. They don't have it listed, so can't really tell. I'm assuming it's under 5%. It may even be negative. And same thing with revenue growth, not listed. It's not one of the initial metrics I look at, but whenever I do a deeper dive, it is one, so I don't mind throwing it in here. Now, a quarterly payout ratio, again, not listed. We saw Yahoo Finance had them in that 300% range, so way too high for me. Now, dividend growth says 1.24%, so they are growing their dividend, though I'm questioning with such a high payout ratio why they are doing that. Growth years 57, maybe it's to maintain the growth years, but I mean, I just don't understand it. If you're having financial problems, cutting the dividend is one way to help with that. Buyback yield is negative at 0.77%. So whenever they are buying back shares, they're not really doing it very efficiently. They're maybe buying back at the wrong times, not whenever they're particularly undervalued. Shareholder yield is positive at 2.7%. Now, this company does pay out on the March, June, September, December timeframe like most companies do. Going back in time here, June 2022, they were paying 79 cents in dividends per quarter. September 2022, they raised that up to 80 cents. September 2023, they raised it up to 81 cents. And September here, most recently in 2024, up to 82 cents. They're basically doing a penny raise every time. So it's not much of a raise, but they're maintaining that dividend growth, the years of growth. They want to maintain that dividend king status is what it looks like, even at the expense of a huge payout ratio. I don't really like it, but let's see how they stack up in the metrics category here. All right, back to the screener. Understand the business. That's where we start. That's why we look at their homepage first, right? They sell tools. That's how they're generating their revenue. Growing free cash flow over the last 4 years. Nope, we had the one down year there in 2021. Growing dividend. It is slowly growing, but again, I'm questioning should they be growing it. Dividend payout ratio, nope, it's over 75%, over 100% at 300% is what Yahoo Finance had it at. Don't like that at all. Dividend yield theory says they're potentially undervalued, so check there. It is not within 15% of a 52-week low. I think it was $89.35 or under is where it needs to be. Not quite there at 93 and some change. Return on invested capital and return on equity, neither one was over 10%. Don't like that. Earnings per share was not listed, so no check there. This should not be here. This is actually from last week, so excuse that price or from the yesterday's one because we did a bank. So excuse that. So only 1, 2, 3 here. That does not make it onto my watch list, 5 of 8, and that is not where it needs to be. So this is not one I'd put on my watch list. It has some financial issues that it is dealing with, which is probably why, and I'm assuming that something in the earnings report was negative, which is why it's dropping, and probably for good reason. Well, that is all for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. And drop a comment down below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Stanley Black & Decker you'd like me to cover on the Stock Pick of the Day series, drop it down below. I'll try to work it in the rotation on a day it pulls back. And drop a comment down below. Let me know what you think of Stanley Black & Decker. Again, is it one you're watching? Is it one you're ready to pull the trigger on? Or maybe you're part of the reason that it dropped today. Is it one you've been selling? Love to hear from you in the comment section down below. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risky candles money. You should never invest any amount you're not comfortable doing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.